On this slide, I will summarise the incremental free cash flows associated with a typical project, and then in the remaining modules in this topic, we'll go through all of these cash flows one by one. There are some cash flows associated with the commencement of the project. In terms of the timing of these cash flows, we say that they occur immediately or at time period 0. Often we need to purchase equipment. There may be other initial development costs to get the project up and running, and often there is an increase in net working capital. Then over the life of the project, there are ongoing cash flows that occur every year. We have incremental revenue, incremental costs, we have taxes associated with the revenue, and a tax shield from the incremental costs. A tax shield means that we pay less tax than we otherwise would because of a particular decision. And then we also have a depreciation tax shield. We pay less tax as a result of depreciation. And then terminal cash flows occur at the end of a project. There may be a salvage value. We may be able to sell the equipment that we've used in the project for a positive amount of money. There may be a tax on the profit or loss from the sale of the asset. There may be other costs to shut down the project, such as restoring the environment to what it was before the project began. And then if we've had an increase in net working capital, then we will recover that net working capital at the end of the project. The nature of some of these cash flows may be clear to you, others you might not be too sure about, but we'll go through them one by one throughout the remainder of this topic.